Hi, I'm Nick Hodge with the Outsider Club, sitting down with the chairman and CEO of Atlantic Gold, Stephen Dean. Atlantic Gold trades in Toronto under the ticker AGB, and in the US, SPVEF. Stephen, it's good to be with you again.
It's great to be here, thank you.
We've done videos like this several times now. You've come a very long way over the past 2 years since I've been covering you. My readers have doubled their money, sold, bought back in. It's been very productive, not only as an investment, but as a mine. You're now the world's lowest cost gold producer. You're growing very rapidly. You're exploring. You have a large land package. We'll explore all that. But first, tell me, is Atlantic Gold going to be acquired?
That's a good question. You know, that's, as significant owners, board and management own about 35% of the company. So that makes us a little bit unusual in that extent. And so we therefore have a fair amount of control in terms of that decision to consider being acquired, or alternatively acquiring other assets and continuing to grow the business. Frankly, we're agnostic about either direction, but what I can say is that what we want to do and what we're very focused on, because of that strong shareholder alignment and the fact that we do own a lot of the company, is that value has got to be achieved, and whether it be by way of an acquisition or further development of organically of our current asset position, or alternatively being acquired, we're open to all alternatives.
Let's talk about the company just for a bit for those who aren't familiar, because there's a lot going on. Can we just have an elevator pitch real quick?
Sure. We went full commercial production March 1 of this year. We have an annualized run rate of production of just over 90,000 ounces. That's our guidance for the year 2018, at around $730 all-in sustaining cash costs Canadian dollars. Which is about $550 US for your US viewers.
This is the lowest cost operation in the gold sector.
It is, and it's really due to a whole bunch of factors that all come together, that combine together to achieve that cost base, and they include a good medium grade for an open pit, great metallurgy. We achieve in excess of 95% recovery of gold mined. We're in a great location. You've been there. 50 minutes from Halifax International Airport, the provincial capital of Nova Scotia. So it means that our workforce drives to work, which is very unusual for a gold mine in the business.
You're not housing them, you're not feeding them.
Correct. And of course the other advantage is that most of our 98% of our costs are denominated in Canadian dollars. So that exchange rate differential against the US dollar gives us an advantage too.
Now, you have major experience, and you've done things, I think, from that perspective since the beginning, and you've done things right. The mine was delivered on time and on budget. Everything has gone very smoothly. Can you talk about your history with majors and how you applied that to Atlantic?
Yeah, and I should say that most of the achievements that we've managed to date can be credited to our President and Chief Operating Officer, Maryse Bélanger. She, like myself, has come from the senior end of town. She was Senior VP at Goldcorp. She was Senior VP at Kinross. I was previously President of Teck, involved in the startup of Normandy. We bring those same standards of professionalism and discipline, I think, to a more junior company, and I think that's part of the reason why we've managed to bring things on time and on budget and deliver the operating results since commissioning. So I would say a real focus on risk management and a real focus on technical excellence. For a company our size, we've got some really deep technical skills that help deliver the outcome that we've managed so far.
And that means grade control. Can we explain that, please?
Grade control. Firstly, it's curiously something that is not commonly done at all here in North America. It's more common in Australia and in Africa. But essentially what we do is we take our proven reserve, which is drilled in the typical way with diamond core, and that builds a resource block model against which we build a reserve. But that's what we call a global reserve. And that's what most companies actually mine from. We would say that's not sufficiently fine-tuned enough and the data is not sufficiently dense enough to practice when you go to mine it. And so what we do in advance of mining and as a mine scheduling tool, short-term mine scheduling tool, is we drill on 5 by 5 meter, typically grid spacing, our next round of ore to be mined, and that gives us something like 25 times greater density of data and helps us better delineate the boundaries between ore and waste. And as a result, we can get a better prediction of tons and grade that we're going to feed to the mill well in advance or when we go to mine it. And that's essentially de-risking the risk of deviations from that ore reserve of tons of grade to the mill, which a lot of miners have trouble with. It does cost us a little bit, about 60 to 80 cents a ton, but we argue it's well worth it because the consequence of not doing that and getting it wrong is probably in excess of $100 a ton by sending waste to the mill or good ore to the waste dump. It's a risk management tool that allows us to better manage the business, and in this industry where the capital markets have been historically critical of the sector for not being better custodians and managers of capital and being better managers of risk, that's just one of the sorts of tools that we use to help achieve that.
And you say it adds a few cents, but what does that mean? I mean, it's part of the bigger picture that helps you be the lowest cost producer in the world. So if it takes a little bit, you would be penny wise and pound foolish if you didn't do things like that, I would say.
100%.
So you're gearing up for about 90,000, upwards of 90,000 ounces production this year, but there's still significant exploration upside. You have a 4-phase approach to this company and this asset. Can you describe the mineralization, the string of pearls theory, and the current and ongoing exploration?
Sure. Well, phase 1 is what you just talked about, the 90,000 ounces at around $550 US an ounce all-in cash costs. And our phase 2 expansion, which we only announced in January of this year, actually before we achieved commercial production on our phase 1, phase 2 talks about us expanding our production base from 90 to about 250,000 ounces of production annually at around the same cash cost at around the $550 US an ounce. And that's from known deposits. That's essentially, as you know, Nick, the 15 Mile and Cochrane Hill deposits and bringing those into the life of mine plan. And that is in the engineering phase now and in the environmental permitting and approval phase over the next 2 to 3 years. And we're expecting to bring 15 Mile Stream on the first deposit of the second two in around 2021, and then followed by Cochrane Hill in 2022. Beyond that, and this is where I really get excited when I wake up in the morning, is what we call our phase 3 and phase 4 expansion. Phase 3 is expanding those resources at Cochrane Hill and at 15 Mile Stream, because what we've found through the engineering to bring the deposit to a construction stage is that there's more ore there than we thought, and we haven't closed it off. So we've brought the drill rigs back again last year, and we've done some more drilling, about 40,000 meters of drilling at those deposits. And in fact, it turns out we still haven't closed it off, and this week we brought the rigs back again because we've got a target date of December 31 to draw a line to update our resource and reserve estimates for all deposits, and we want to make sure that we get all of the ounces that will report to a pit from those two deposits inside a pit by the end of the year. So we've got 2 rigs turning there. We've got another 3 or 4 rigs turning on what we call our phase 4 program, which is the whole corridor. We've got 50 kilometers of the right rocks where all of those deposits are currently hosted in an anticlinal structure, which is the structure that in folding of the Earth's crust creates the plumbing, the piping for the juices that host the mineralization, typically in the nose, where my fingers are, in the nose of those fold axes. That's where we see the best mineralization and near surface mineralization. We've only just touched the surface of that, and in fact, our regional program, which is a plus 100,000 meter drilling program over that 50 kilometer long strike length, our first target was a prospect called 149. It's only a kilometer away from the 15-mile stream deposit where we're going to build our next concentration plant. We hit mineralization over initially a 300-meter strike length, within 50 to 70 meters of surface, so really shallow, which tends to make us believe that this is going to be a low strip proposition. We've since done some more drilling. That strike length is now out to 475 meters. And what we hear from our chief geoscientist, a lady by the name of Dr. Sally Goodman, who's one of the best structural geologists in the world, that she thinks the best part of this deposit could well be to the east of where we've already drilled, because she's seeing in the geophysics more complex folding than where we've already drilled, and that we know that where that folding becomes more complex tends to mean better mineralization. So we're now stepping the rigs out to pursue that over the next month or two to see what we can find in that eastern zone. The big picture excitement for us with that is that this was the start of a year-long plus program of 100,000 meters of drilling, and the first target we hit that's never been drilled before, we hit mineralization. So that lends us to believe that there's a lot of mineralization along this corridor, and we've got to keep the drill rigs turning.
This is an incredibly exciting project. It's in production, it's growing, it's low cost, there's blue sky exploration, and I think it's a fantastic time to enter the stock. It hit nearly $2, has pulled back a bit. For those that are thinking about buying the stock, or even those that already own it, what can they look forward to in the next 6 months from Atlantic Gold?
Well, we've got a lot of catalysts in the pipeline with news flow.
You mentioned the resource update that you got a cutoff for.
Resource update, that's coming in early January as a result of the December 31 cutoff. But even before that, we've got our Q3 production releases, which will come out in, let me think, middle of November or thereabouts. We had a good Q1, that was a startup pre-commercial. First full commercial production quarter of Q2 this year, 2018, was a better quarter than Q1, and we're expecting an even better quarter than Q2 with good costs and slightly higher gold production in the period to the end of September. So we'll publish that in the next 6 weeks or so, and of course drill results. We've got 6 drill rigs turning at resource expansion at Cochrane and 15 Mile. We've got the drilling to the east of 149, and then we've got the 50-kilometer strike length program that's also running separate to that. So lots of news flow, lots of updates coming.
Stephen, thanks so much for joining me. I could continue to ladle on the superlatives, but I think we'll leave it there. Stephen Dean, Chairman and CEO of Atlantic Gold, thank you very much.
Thanks, Nick.